The elevator operator's hands were shaking as he watched the numbers climb. 21st floor, 22nd, 23rd. He had seen millionaires ride these same elevators just hours before, confident and commanding. Now he was carrying broken men to their offices one last time. It was Thursday, October 24th, 1929, and Wall Street was about to witness the most devastating financial collapse in American history. But here's what most people never understood about that day. The crash didn't happen because the market suddenly went insane. It happened because for years, everyone had been living a lie. Picture this. It's 1928 and America is drunk on prosperity. The Great War is over, factories are humming, and everyone from your barber to your grandmother is talking about stocks, radio broadcasts, feature market updates like sports scores. Newspapers run headlines about ordinary people becoming millionaires overnight. The Dow Jones has tripled in 5 years. Money seems to grow on trees, and those trees are planted all over Manhattan. But beneath the champagne toasts and ticker tape parades, something sinister was building. The entire American economy had become a house of cards balanced on borrowed money, wild speculation, and the dangerous belief that prices could only go up. Wall Street wasn't just trading stocks anymore, it was manufacturing dreams and selling them to a nation that had forgotten the difference between wealth and wishful thinking. The morning of October 24th started like any other day on the street. Traders arrived at their usual time, newspapers tucked under their arms, coffee steaming in paper cups. The opening bell rang at 10 o'clock sharp, just as it had for decades. But within minutes, something was terribly wrong. Prices weren't just falling, they were collapsing faster than anyone could process. The ticker tape machines, those mechanical heartbeats of American capitalism, began spitting out a relentless stream of bad news. General Electric dropped 10 points in the first hour. Radio Corporation of America, the darling of the new technology boom, plummeted 30 points before lunch. U.S. Steel, the backbone of American industry, was hemorrhaging value by the minute. But these weren't just numbers on a board. Each falling stock represented thousands of families watching their life savings evaporate in real time. What made this day so devastating wasn't just the speed of the collapse. It was the complete breakdown of trust that had held the entire system together. For years, Americans had been buying stocks on margin, meaning they borrowed money to purchase shares they couldn't afford. A typical investor might put down 10% of a stock's price and borrow the rest, betting that rising prices would cover the loan. It worked beautifully as long as prices kept climbing. But when they started falling, the whole scheme unraveled like a cheap sweater. Banks that had eagerly loaned money for stock purchases suddenly demanded immediate repayment. Brokers issued margin calls by the thousands, forcing investors to either deposit more cash or sell their shares at a loss. But here's the cruel mathematics of panic. When everyone tries to sell at once, there are no buyers left. Prices don't just fall, they crater. The human drama playing out on the trading floor was unlike anything America had ever seen. Grown men wept openly as fortunes disappeared. Traders shouted themselves hoarse trying to find buyers for stocks that hours earlier had been considered blue-chip investments. The noise was deafening, a cacophony of desperation that echoed through the marble halls of the New York Stock Exchange like the sound of an empire breaking apart. Outside on Broad Street, crowds gathered as word of the disaster spread. These weren't just curious onlookers. Many were investors themselves, ordinary Americans who had trusted their futures to a market they barely understood. They pressed against police barriers, straining to catch glimpses of the chaos inside, their faces reflecting the growing realization that their world was coming apart. The telephone system buckled under the strain as panicked investors tried to reach their brokers. Lines jammed, connections failed, and desperate voices pleaded for information that might save their financial lives. Western Union reported record volumes of telegrams as the bad news spread across the country faster than a prairie fire. Every message carried the same terrifying theme: sell everything before it's too late. But selling had become nearly impossible. The volume of trading was so enormous that the ticker tape machines, already antiquated technology, fell hours behind the actual market. By noon, the tape was running 2 hours late. By 3 o'clock, it was 3 hours behind. Traders were making life-or-death financial decisions based on prices that were already ancient history. It was like trying to navigate a hurricane with a map from yesterday's weather. The irony was savage. Wall Street, the supposed pinnacle of American financial sophistication, had been reduced to chaos by its own success. The very mechanisms that had made the boom possible, the credit systems and margin accounts and speculative instruments, were now amplifying the disaster beyond anyone's worst nightmares. Every safety valve had become a pressure cooker. Richard Whitney, the vice president of the New York Stock Exchange, walked onto the trading floor that afternoon carrying the hopes of American capitalism on his shoulders. He approached the post where US steel was traded and placed a massive buy order at a price well above the current market. The message was clear. Organized money was stepping in to support the market. For a brief moment, the panic subsided. Prices steadied, then actually rose. But it was theater, not salvation. Whitney was acting on behalf of a consortium of major banks that had pooled their resources to create the illusion of stability. They bought stocks not because they believed in their value, but because they feared what would happen if the collapse continued. It was financial triage, an attempt to stop the bleeding long enough to figure out what had gone wrong. The temporary rally fooled no one for long. By the closing bell, the Dow had lost 11% of its value in a single day. Trading volume had shattered every record, with nearly 13 million shares changing hands. The ticker tape didn't finish printing the day's transactions until after 7 o'clock that evening. More than 4 hours after the market had closed, Wall Street had processed more financial devastation in 8 hours than it typically saw in a month. But Thursday was just the beginning. The real horror was still to come, because the fundamental problems that had caused Black Thursday weren't solved by Richard Whitney's dramatic gesture or the bank's intervention. They were merely postponed. The margin calls kept coming, the forced selling continued, and the terrible mathematics of panic ground on relentlessly across America. Families gathered around their radios that evening to hear the news from Wall Street. The reports were grim, but incomplete. Most Americans still didn't understand that their prosperity had been built on borrowed money and borrowed time. They thought this was a temporary setback, a brief correction in an otherwise healthy market. They had no idea they were witnessing the beginning of the end of the greatest speculative bubble in human history. The weekend that followed was filled with desperate meetings in mahogany boardrooms and frantic telephone calls between financial capitals. But the damage was already spreading beyond Wall Street's ability to contain it. The crash had exposed fundamental weaknesses in the American economy that went far deeper than stock prices. Banks that had seemed rock solid were suddenly revealed to be dangerously over-leveraged. Companies that had appeared profitable were shown to be propped up by accounting tricks, and speculation Monday would bring fresh horrors, and Tuesday would be even worse. But that Thursday, October 24th, 1929, would be remembered as the day American capitalism looked into the abyss and realized it had been walking on air all along. The banking titans who gathered in J.P. Morgan's private office that Friday evening looked like generals planning a final stand. These were the men who had built America's financial empire, who had weathered every crisis from the panic of 1907 to the disruptions of the Great War. But as they stared across the polished conference table at each other, something had changed. The confidence that had carried them through decades of triumph was cracking like ice in a spring thaw. Charles Mitchell of National City Bank loosened his collar as he reviewed the preliminary damage reports. His institution had extended millions in margin loans to speculators who were now financially obliterated. Albert Wiggin of Chase National sat in stony silence, calculating losses that threatened to dwarf his bank's entire capital base. These weren't just numbers on a ledger, they were death sentences for institutions that had seemed immortal just days before. The conspiracy of optimism that had sustained the boom was finally breaking apart. For months, these same men had publicly proclaimed that stock prices reflected genuine economic strength. They had assured depositors that banks were sound, that credit was flowing to productive enterprises, that America's prosperity was built on solid foundations. Now they were discovering that they had been lying to the public and, perhaps worse, to themselves. The margin lending system that had seemed so brilliant during the boom revealed itself as a weapon of mass financial destruction. Banks had loaned money to brokers, who loaned it to investors, who used it to buy stocks that served as collateral for the original loans. It was a perfect circle as long as prices rose. But when they fell, the circle became a noose that was strangling everyone involved simultaneously. Thomas Lamont of J.P. Morgan and Company spread out the weekend's newspaper clippings across the mahogany table. The headlines told a story of spreading panic that was already metastasizing beyond Wall Street. Stocks collapse in 16,410,030 share day, screamed the New York Times. Worst stock crash stemmed by banks, proclaimed the Herald Tribune. But beneath the bold type, smaller stories revealed the human cost. Ruined speculators jump from buildings. Families lose life savings. Midwest banks report the heavy withdrawals. The contagion was spreading faster than wildfire through a drought-stricken forest. Regional banks from Chicago to San Francisco were reporting massive runs as depositors, terrified by news from New York, demanded their money in cash. But these banks had invested heavily in the same securities that were now worthless. They couldn't honor withdrawal requests because their assets had evaporated along with Wall Street's credibility. What terrified the banking elite most wasn't the immediate losses. It was the realization that the entire credit system had become a house of mirrors, where every debt was secured by another debt, and every asset was someone else's liability. The complexity they had celebrated as financial innovation was now revealed as dangerous instability. Nobody knew who owed what to whom, or whether any of it could ever be repaid. The psychological damage was proving just as destructive as the financial carnage. Consumer confidence, that invisible force that had powered a decade of prosperity, was collapsing as dramatically as stock prices. Families that had felt rich on Thursday were discovering their poverty by Monday. The spending spree that had driven American industry was about to become a savings panic that would strangle economic growth for years to come. Factory owners across the industrial heartland were already reporting cancelled orders and delayed payments. The automobile industry, symbol of American dynamism, watched as customers who had been planning to buy new cars suddenly couldn't afford the payments on their old ones. Department stores that had expanded rapidly to serve newly affluent consumers found themselves staring at empty floors and mounting debts. The international implications were equally terrifying. European banks had invested heavily in American securities, drawn by the promise of endless profits in the world's most dynamic economy. Now those investments were worthless, threatening to drag down financial institutions from London to Berlin. The crash that had started in Manhattan was becoming a global catastrophe that would reshape the world's economic order. By Monday morning, the temporary optimism generated by the bankers' intervention had completely evaporated. Trading opened to a fresh wave of selling that made Thursday's panic look restrained by comparison. The ticker tape fell even further behind, creating a fog of uncertainty that made rational decision-making impossible. Brokers were executing trades based on prices that were hours old, adding chaos to an already desperate situation. The human stories emerging from the wreckage were becoming legend even as they happened. Jesse Livermore, the most famous speculator of his generation, had correctly anticipated the crash and made millions by betting against the market. But for every Livermore, there were thousands of ordinary Americans discovering that their comfortable retirements had vanished overnight. College professors, small-town doctors, and middle-class families who had trusted their savings to Wall Street's promises were learning the brutal difference between paper wealth and real security. The margin calls continued their relentless assault on over-leveraged investors. Brokers who had been happy to extend credit during the boom now demanded immediate cash payments that their clients couldn't possibly provide. Forced liquidation sales drove prices even lower, creating a vicious cycle that fed on itself like a financial cancer. Every attempt to stabilize the market only revealed new depths of instability. Perhaps most devastating of all was the collapse of trust itself. The stock market had represented more than just a place to trade securities. It had become a symbol of American capitalism's superiority, proof that free markets could create unlimited prosperity for anyone willing to participate. Now that symbol was revealed as an illusion, and the faith that had sustained it was bleeding away as quickly as the money. The weekend meetings in bank boardrooms grew increasingly desperate as the full scope of the disaster became clear. These weren't temporary market fluctuations that could be managed with coordinated buying programs. They were the symptoms of fundamental economic disease that had been masked by years of artificial prosperity. The patient wasn't just sick, the patient was dying, and the doctors were discovering they had been administering poison instead of medicine. Tuesday, October 29th, was approaching like an executioner's appointment. The financial elite knew that their intervention had bought only days, not salvation. The forces they had unleashed during the boom were now beyond their control, and the reckoning they had postponed was about to arrive with compound interest. Wall Street's last hours of the old world were ticking away, and nothing would ever be the same again. Would ever be the same again. Tuesday morning arrived like a funeral march. The elevator operators who had carried titans of industry to their corner offices now transported hollow-eyed men who looked like they had aged decades in a weekend. The marble lobbies of Wall Street's greatest institutions echoed with whispers instead of the confident conversations that had once filled them. Everyone knew what was coming, but no one wanted to speak it aloud. The opening bell on October 29th unleashed a selling frenzy that made Black Thursday look like a minor tremor before an earthquake. Within the first 30 minutes, over 3 million shares had changed hands, and every single transaction was a desperate attempt to escape the inferno. The ticker tape machines, already overwhelmed, began printing a story of financial apocalypse that would be remembered for generations. What made this Tuesday so much worse than Thursday wasn't just the volume of selling, it was the complete absence of buyers. The organized support that had briefly stabilized prices the week before had evaporated like morning mist. The banks that had pooled their resources to create artificial demand were now fighting for their own survival, unable to throw good money after bad in a market that seemed determined to destroy everything in its path. Radio Corporation of America, the stock that had symbolized America's technological future, opened at $68 and fell to $44, before most people had finished their morning coffee. General Electric, backbone of American industry, shed 20% of its value in the first hour of trading. But these weren't just numbers flickering on boards. They were the dreams and retirements and college funds of millions of Americans dissolving in real time. The noise on the trading floor had changed from the energetic chaos of a boom market to something darker and more primal. Grown men screamed themselves hoarse, not in excitement, but in desperation. The sound of fortunes being destroyed is different from the sound of fortunes being made, and everyone in that cathedral of capitalism could hear the difference. It was the sound of an empire eating itself alive. Outside the exchange, crowds pressed against police barriers with a mixture of fascination and horror. These weren't just spectators watching someone else's disaster. Many were investors themselves, ordinary Americans who had trusted their futures to a system that was now revealing its true nature. Faces in the crowd reflected the dawning realization that the prosperity they had taken for granted was nothing more than a shared delusion. The telephone networks that connected Wall Street to the rest of America buckled under unprecedented demand. Desperate investors from coast to coast tried to reach their brokers, only to find busy signals or disconnected lines. Telegraph offices reported record volumes as panic spread across the continent faster than any train or automobile could carry it. The infrastructure of American finance was collapsing under the weight of its own success. Inside the exchange, the ticker tape had fallen so far behind actual trading that prices being reported were from a different universe. Brokers were making decisions based on information that was 3, 4, even 5 hours old. It was like trying to fight a battle with yesterday's intelligence, and the results were predictably catastrophic. Every decision made in this fog of uncertainty only added to the chaos. The margin calls that had started as a trickle the previous week became a flood that swept away entire family fortunes. Investors who had felt wealthy on borrowed money discovered that debt is a fair-weather friend. When prices were rising, leverage had multiplied their gains. Now that prices were falling, it was multiplying their losses with mathematical precision that would have been beautiful if it weren't so devastating. Banks across America faced a nightmare scenario they had never imagined possible. The securities they had accepted as collateral for loans were now worth a fraction of the debt they secured. Regional institutions from the Great Plains to the Pacific Coast reported massive withdrawals as customers, terrified by news from New York, demanded their deposits in cash. But cash was exactly what these banks didn't have. The psychological damage was spreading faster than the financial contagion. Consumer confidence, that mysterious force that had powered a decade of growth, was collapsing as dramatically as stock prices. Families that had planned major purchases were suddenly afraid to spend money on necessities. The optimism that had built America's industrial economy was being replaced by a fear that would paralyze commerce for years to come. Factory owners received cancellation after cancellation as customers who had seemed creditworthy last week revealed themselves to be financially ruined. The automobile plants of Detroit, symbols of American dynamism, began shutting down production lines as orders evaporated. Department stores that had expanded to serve newly affluent consumers found themselves staring at empty floors and unpayable debts. The international implications were becoming clear as European markets opened to their own waves of panic selling. London, Paris, and Berlin watched their exchanges crater as investors realized that American securities in their portfolios were worthless. The crash that had begun in Manhattan was becoming a global catastrophe that would redraw the world's economic map. By midday Tuesday, even the most optimistic observers were forced to confront reality. This wasn't a correction or a temporary setback. It was the end of an era, the collapse of a financial system that had seemed as permanent as the marble buildings that housed it. The prosperity of the 1920s was being revealed as a mirage, and the desert of economic hardship that lay beneath was vast and unforgiving. The human stories emerging from the wreckage were heartbreaking in their simplicity. A hardware store owner in Ohio watched his retirement savings disappear as the bank stocks he had trusted crumbled. A schoolteacher in Kansas discovered that the college fund she had built for her children was gone. A factory foreman in Pittsburgh realized that the house he had been buying on credit was now worth less than what he owed. These weren't abstract economic statistics. They were the lives of real people who had believed in the American dream and discovered that dreams can become nightmares without warning. The stock market had promised them a shortcut to prosperity, but it had delivered them to financial ruin with ruthless efficiency. The forced liquidation sales continued their relentless destruction of wealth. Every margin call triggered more selling, which drove prices lower, which triggered more margin calls in an endless cycle of destruction. It was a financial death spiral that fed on itself, growing stronger with each revolution. The mathematics of panic had taken on a life of their own. Perhaps most terrifying was the realization that no one really understood how far the damage would spread. The interconnections between Wall Street and Main Street, between banks and businesses, between creditors and debtors, had become so complex that mapping the full extent of the catastrophe was impossible. The financial system had become a web so intricate that pulling one thread could unravel the entire structure. The banking elite, who had seemed so powerful just days before, were revealed as helpless spectators to forces beyond their control. The emergency meetings in marble boardrooms continued, but the tone had changed from confidence to desperation. These men who had built financial empires were watching them crumble and discovering that they had no idea how to stop the destruction. The ticker tape finally caught up with the day's trading at 7:08 p.m., more than 3 hours after the closing bell. The final tally was brutal. Over 16 million shares traded, the Dow down 30 points. Billions of dollars in paper wealth simply erased from existence. But the numbers couldn't capture the human cost of what had happened. An entire nation's faith in the future had been shattered in a single day. As darkness fell over Wall Street that Tuesday evening, the lights in office windows told stories of men trying to salvage something from the wreckage. Some were calculating losses, others were writing resignation letters, and a few were simply staring into space, trying to comprehend how their world had collapsed so completely and so quickly. The crash of 1929 was over, but its consequences were just beginning. The decade of prosperity that had seemed so solid was revealed as a house of cards, and the wind that had blown it down was still gathering strength. America was about to learn the difference between wealth and speculation, between genuine prosperity and borrowed time. The lesson would be written in unemployment lines, bread lines, and broken dreams that would define a generation. But that Tuesday night, as the last lights went out in the towers of finance, one thing was already clear. The world that had existed on Monday morning was gone forever, and whatever would rise from its ashes would be built on very different foundations. The age of easy money was over. The age of hard lessons was about to begin. The elevator that had carried titans to their thrones now descended for the final time that day, its operator no longer shaking but strangely calm. He had witnessed the end of an empire, watched as gods became mortals in the span of 8 trading hours. The men who rode down with him stared at floors that had once seemed so far below, now understanding that they had never been as high as they thought. October 29, 1929 didn't just mark the end of the greatest bull market in history. It marked the end of a dangerous delusion that had gripped an entire nation. For a decade, Americans had convinced themselves that prosperity was permanent, that markets only moved in one direction, that borrowed money was the same as earned wealth. They had confused paper profits with real value, speculation with investment, wishful thinking with wisdom. The crash revealed what thoughtful observers had known all along. When everyone believes the same lie, it doesn't make it true. It just makes the reckoning more devastating when reality finally arrives. Wall Street's last hours before the collapse weren't just about falling stock prices. They were about the death of illusions that had seemed too beautiful to question. Today, as we watch markets soar on borrowed money and hear promises that this time is different, the ghosts of 1929 whisper their warning. They remind us that gravity always wins, that what goes up without substance will always come down with violence, and that the most dangerous words in finance are these: it can't happen again. History doesn't repeat, but if you ignore its lessons, it will crush you all the same.